We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrix. I know it's annoying, but if you watch the show on YouTube, please like and subscribe. This helps our channel reach others and continues to help us grow despite touching on topics that are controversial and need to be discussed in public. Joining me today is Joseph Wang, former senior trader on the Fed's Open Markets desk and also the author of Central Banking 101. Thanks for joining me today, Joseph.
Thanks, Tom, for having me. It's a pleasure to be here.
I'm really looking forward to this conversation today because, as we know, we've really come through an era where everything, seems to really be all about the Fed. Everybody watches the Fed and really keys off every one of the Fed's movements. So maybe we can start by having you explain what the Fed's open market desk is and a bit about your experience there.
Yeah, so for those of you who don't know, the Fed actually has a trading desk. It's called the Opens Markets Desk, also known as the Plunge Protection Team, although to be clear, the Fed does not buy equities. The Open Markets Desk does two things. One, it collects intelligence, market intelligence for the Fed, and two, it performs Fed operations. And I'll talk a little bit about both aspects of that. So if you're sitting on the FOMC, you want to understand what's going on in the markets. You don't have time to sit and watch the markets every day. So what you do is you rely on the Fed's trading desk. So, for example, if we see the 10-year spike higher, we see oil implode, if we see the S&P surging higher, the open markets desk is the group within the Fed that tries to figure out what's happening with the markets, and they compile a report and send it over to the Board of Governors. The way this would work in practice would be, for example, let's say there was a big incident in the treasury markets. Let's say yields spiked or yields plummeted. So what the desk would do is they would go through their extensive list of contacts and try to figure out, piece together a story as to what happened. If you're on the Fed's trading desk, you have direct lines to all the big major banks, and you have relationships with basically all the major asset managers in the world, from foreign central banks to giant hedge funds. And so what the Fed's trading desk would do is that we would just call all of them, and they'd give us their input, their views as to what they think happened. And they understand that everything they say is confidential, so they're a lot more candid than they would be on, say, CNBC. The Fed's trading desk also has access to a lot of confidential data, so they can kind of look at the confidential data, talk to a bunch of people, and come up with a view as to what's happening in the markets, what's driving prices. My own view is that this is one of the few centers of the financial markets where you can actually get a pretty good idea of what's going on behind the curtain. And so it was a tremendous learning experience for me. The second part of what the desk does is they perform market operations on behalf of the Fed. And what that means is, let's say the Fed wants to do QE, go out and buy treasuries, then it's the open markets desk goes out and buys a bunch of treasuries. Let's say the Fed wants to go save the dollar world. They want to do, let's say, FX swap loans. So the desk goes out and does that. Let's say they want to do repo loans. The desk goes out and does that. So they basically are literally the trading desk on behalf of the entire Federal Reserve System. And it's also, in my experience, a tremendously good way to learn about, just how the market functions just how the financial system functions, because you have to get into very much the nitty-gritty of just who's buying, who's selling, and how does that work throughout the financial system.
Mm-hmm. Well, that's really interesting because, we often hear that the Fed is making decisions based off of really backward-looking data. So, to understand that the Fed has this arm to really try to understand the market is, I think, really important to understand. And, it seems like the Fed is always kind of accused of making decisions based on this backwards-looking data, whether it's job growth or CPI. So, does that really make the Fed a lot more effective in analyzing the state of the economy and the markets?
So it definitely helps to have additional data, additional input. But I'd caution about data that is both backwards looking and forward looking, though. The reason being is that the economy is always changing, and what we're seeing today, for example, is structurally it seems to be an economy that's very different from what was happening beforehand. A lot of the big economic models that the economists, both in the private and public sector, have been using don't seem to work very well. And to be clear, they never worked very well, but they work particularly poorly now today.
Mhm.
So what people think of as forward-looking, what people think of as backward-looking, is really dependent upon, let's say, the economy not changing today than it was before. So it's, to me, it's not super clear if the Fed is just, again, looking at backward-looking data and maybe making another policy error. Um, uh, that being said, when you're dealing with the economy, that's something that's extremely complicated and adaptive, and you're working with tools that are very blunt, like interest rates, you're never going to get it perfectly right. So I think people often fault the Fed for doing, let's say, being too tight or being too loose. But that's inherently something that's very difficult to do, even if you had not just backward looking or forward looking data, even if you had perfect data today.
Mhm.
Um, there are always things happening in the world that you just don't predict, and the tools that you have, interest rates, though they affect the real economy and the financial economy differently, and even within the real economy and even within the financial economy, they affect different sectors within them differently. So we're in a position where it's always hard to do a good job.
So, Joseph, what data does the Fed, let's say, weight most heavily to choose where it wants to set interest rates and set the balance sheet to? And in your opinion, is the Fed acting appropriately at this time?
So I think looking at the balance sheet and looking at interest rates, you look at separate, those are two different parts of the policy transmission mechanism, and I think you look at different data for that. um, when you're thinking about the policy rate, let's say how high the overnight rate should be, which is what people think of when the Fed is raising rates, that a lot of that has to do with what the Fed economists think is the right policy rate. So if you're a PhD economist in the Fed and the Fed has a few hundred, you think of the world in terms of something what they think of as R star, which is the rate where which is the real interest rate where the economy is neither expanding nor contracting. And from their perspective, if you figure out R star is, then you can decide whether or not monetary policy should be accommodative or restrictive. Now, for the sake of argument, let's say R star is 2%. And that means if you raise the real rate above R star to say 3%, what you're doing is you're moving monetary policy to a contractionary stance. And so growth will slow and inflation will come down. By the same token, let's say you moved the real interest rate to 1%, then 1% being below R star, you're doing accommodative monetary policy. So you're encouraging the economy to expand and you're encouraging inflation to go higher. So where the Fed goes about setting interest rates has to do with what their economists perceive to be where R star is, and and that's based upon their models and data. Uh, and it's probably usually inaccurate, but it's the best that they can do. Now, the second part, when it comes to setting the balance sheet, that's a very different aspect of it because that has to do with the financial markets. And when you're talking about the financial markets, there's a lot of uncertainty to it. The Fed relies a lot upon market participants and the open markets to decide how they go about doing that. For example, let's say they want to do quantitative easing. They want to send a strong signal to the markets that they're going to be easing policy. Okay, so how big should their purchases be? 30 billion, 40 billion, 50 billion? The way they go about setting that has to do with, let's say, judgments from the FOMC trading desk, but also trying to figure out what's priced into the market. So what they would do in that instance they would survey a whole bunch of large investors and ask them, so what do you expect the Fed to do in terms of QE? 40 billion, 50 billion, 60 billion. And once they come out with that estimate from that survey, they can kind of know what they would do to either surprise the market to the upside or to the downside. Now, for example, let's say the market fully expects, based on surveys, the Fed to do $50 billion in QE. Now, let's say the FOMC wants to surprise the market by being extra dovish. Then they'll go and next month and they'll say, I'm going to do 60 billion in QE because that was more than what the market priced, then that's a dovish surprise. So for the market aspect, the balance sheet aspect, that's a lot more, I guess, qualitative and judgment based than the other parts of it. Now, when you're asking whether or not the Fed is making a mistake right now, I don't think they are. So very obviously, inflation is extremely high. CPI is at 7-8%, but the Fed funds rate has also been rising a lot as well. So it looks like we'll be at 4.5 or maybe 5% within a few months. But the way that I think of inflation is that inflation can continue to rise as long as people have enough money to afford higher prices. And I think it's helpful to think about just where people get the financing to afford higher prices. Um, from my view, they get it from three different aspects. They get it from higher wages. Well, if you're making more money from your job, then obviously you can afford higher prices. Then inflation can persist at a higher rate. The second portion is you can borrow it. So if credit growth, let's say credit growth either from from a bank or from credit cards continues to grow at a very high rate, then people can continue to afford higher prices. And the third way that people can finance their purchases is just through the wealth effect. If you have the stock market going to the moon, well, then you're feeling wealthier, you have money to spend, then you can go and afford higher prices. Now, just judging by these three aspects, it doesn't appear that you see a moderation in any of them just yet. If you're looking at wages are growing at 6.5%, 7% per year. Now, if your income is rising by 6.5% a year, then obviously you can continue to afford price rises that are much higher than 2%, which is the Fed's target. So it doesn't seem to have slowed down now. And there are structural reasons to think that wages can continue to rise simply because of demographics. We have fewer people working today than we had pre-pandemic. The second aspect has to do with financing. And well, even though interest rates have risen a lot, inflation is also very high. It doesn't seem to have deterred a lot of people from borrowing. If you look at credit growth from weekly statistics, it continues to be at a rate that's very elevated compared to pre-pandemic. Now, to be clear, you see certain segments slowing down, like in housing. That 7% mortgage rate is acting as a brake on things. But the Fed is now the market seems to be pricing in a little bit less than that, and you could have that easily reverse. Let's say mortgage rates go down to 5%, maybe everything starts to inflate again. And the last part, of course, has to do with asset prices. Now, the stock market, broadly speaking, is down for the year. Let's say 20% down, but compared to 2 years ago, it's up enormously. So people still have a lot of wealth to spend. So based upon all those factors, it seems like at the current interest rates, the Fed hasn't done enough to accomplish their goals, which is to move inflation to 2% target. So I think that what they're doing is right, but they're not done yet, which is exactly what they say.
Mm-hmm. So, when we think about these two tools that the Fed has of adjusting rates and adjusting the balance sheet, how do these two tools act, let's say, on different parts of the curve?
So the two tools operate on different parts of the curve, exactly as you mentioned. So the two main tools that the Fed has is the overnight rate and their balance sheet. And among the two, the overnight rate is the much more important rate. And you can kind of think of it as the rate that the risk-free overnight rate, how much money how much return you can get if you let your money overnight. So that overnight rate is an important anchor in setting how interest rates will be, let's say, through 5 years out. Now, put yourself in the shoes of an investor. Let's say you're an investor with $100 million. You're thinking of investing at a term of 3 years. What would be the return that you'd be willing to accept on that 3-year loan? The way that the market goes about divining this is that they say, well, I can either lend at a 3-year term, or I can lend overnight at the risk-free rate every day for 3 years. And those two rates have to be equal, have to be comparable. So in determining what the 3-year interest rate would be, the investor would have to guess as to what the Fed's overnight rate will be over the next 3 years. And usually that's pretty clear. So the Fed will come and try to guide the market and say, for example, I want to keep the overnight rate, the federal funds rate, around 4% for the next few years. And if they go out and say that, and you believe them, then you're an investor lending at 3 years, and you're say, I'm not going to accept anything less than 3 years, than 4%, because otherwise I could just lend to the Fed or lend overnight risk-free uh, for 4% over 3 years. And it's that expectation as the path of policy over the next few years that through which the Fed influences shorter to medium dated interest rates by adjusting the overnight rate. Now, when you're thinking about the other segments of the yield curve, let's say 5, 10, 20, 30 years, it's less about expectations of what the Fed would do, because really no one has any idea what the Fed would do 5, 10 years from now. And it has a lot more to do with supply and demand. So if you rewind back to during the great financial crisis, the economy was not doing well in 2008, and the Fed cut interest rates to zero, but it wanted to provide additional accommodation to the markets, even though rates were already at zero. Now, they were unwilling to do negative, so they thought about the next best thing. So they'll go and try to lower longer dated interest rates by just going out and buying a whole bunch of treasuries, deploying their balance sheet. So if they go out, if they buy trillions of dollars of treasuries, that puts upward pressure on the price of treasuries, which is to say downward pressure on yield. So yields are inverse to prices. Mm-hmm. So that's how they operate. It operates on two different segments. From the Fed's perspective, though, they don't actually feel very comfortable with a large balance sheet. It does seem to work, but they don't really feel like they understand why. So one of the things they're trying to do right now is they're trying to shrink their balance sheet through quantitative tightening and rely more on the overnight rate to adjust policy.
You bring up the idea of shrinking the balance sheet, and there seems to be a lot of misconceptions around how and when that occurs. So, getting into the weeds a little bit, I think it's important to understand why we didn't necessarily see the balance sheet run off right away, and we're still seeing some asset purchases as part of that, despite the Fed saying that they're going to be, making the balance sheet much smaller along with tightening rates.
Yeah. So I did see on Twitter, there were a lot of people complaining that the Fed was not being honest, that they were saying that they would shrink the balance sheet by X amount, but when they look at the data, it didn't actually shrink by X amount. Now, the reason why there's this apparent discrepancy has to do with just some very technical issues about the Fed's balance sheet. I'll give you two examples. So the Fed, for example, it's telling you that every month it's going to let $60 billion in treasuries roll off. And it's doing exactly that. But sometimes it doesn't appear that way, because even as it's letting its treasury holdings shrink by 60 billion a month, parts of its treasury holdings are actually growing. They're growing because parts of the Fed's treasury holdings are inflation adjusted. So the Fed holds a whole bunch of TIPS, which are treasury inflation protected securities. And what that means is that, so the way that a TIP security works is that in order to protect the investor from inflation, every month it adjusts the principal higher in line with CPI. So let's say you bought $100 in principal in TIPS, and after a year of 10% inflation, you would have $110 in principal. Now, the Fed owns a whole bunch of these, and as inflation is high, every month the treasury holdings of the Fed go up a little bit through that inflation adjustment. So on the one hand, let's say the Fed's treasury holdings dropped by 60 billion, but perhaps the TIPS appreciation added 5 billion. So maybe it appears that overall they only dropped 55 billion, when in fact they did drop 60 billion. It's just that the TIPS are also appreciating. The second aspect to this is the MBS portfolio. Now, the MBS portfolio is a bit different in the sense that when the Fed purchases an MBS security, it doesn't have to take delivery of it for another 3 months. So early on during QT, the MBS holdings of the Fed were actually growing a little bit. That was because some of the MBS securities that the Fed had purchased the months prior were just settling. So there's that purchase and settlement time difference that was confusing some people. And the last point that I make, and that you hinted on, is that it seems like sometimes the Fed is still buying things, even though they said that they would stop and they were doing quantitative tightening. And that has to do with the fact that the Fed reinvests securities that it receives in excess of its cap. So going back to treasuries as an example, every month the Fed promises to let at a maximum of $60 billion in treasuries roll off. Now, what happens if, say, next month it receives repayments of $100 billion in treasuries, but its cap is only $60 billion? So if it received $100 billion in treasury principals being repaid next month, that's 40 above its cap. So what does it do with that extra 40 billion in principal? It reinvests them into newly issued treasuries, and those have to be purchased. And that's why it looks as if the Fed is purchasing treasuries, which they are, but they're not expanding their balance sheet. They're simply rolling over maturing proceeds.
Mhm. Joseph, I've heard you speak before as well about a strategy to support the markets without involving Congress, and that's by issuing Treasury buybacks. So how do these work?
So I think it's helpful to have some background as to what's happening. So for those of you who are not familiar with the Treasury market, there's tremendous instability in it. If you look at the past few months, Treasury yields have been floating higher, and they've been moving in an erratic way. Sometimes you have yields surging 20 basis points. Sometimes you have them crushing lower by 20 basis points. So there's instability in what is perceived as the most important and most liquid asset in the entire financial system. And add to that, if you look at what happened in the UK just a few weeks ago, their okay. So what their sovereign debt market is called gilts. So the gilt market basically imploded. The gilt yields surged higher because of a liquidity squeeze, and the Bank of England was forced to come in and stabilize the market by being a buyer of last resort. So the official sector is looking at what's happening in the sovereign debt markets at home and abroad, and they realize that maybe there's a problem here. And so one of the solutions they're thinking about is something called a Treasury buyback. And what that means is that the U.S. Treasury goes back and, as the name implies, it goes back and it buys its own debt.
Mhm.
This has been done in the 90s before. And in the 90s, what happened was that the Treasury had a surplus, so its tax receipts were greater than its expenditures. It had some extra money lying around, and so it went and it bought back some of the higher interest rate debt to try to save money for the taxpayers. This time around, what they're trying to do is they're trying to issue new debt and using the proceeds to buy back some older, less liquid debt. For those of you who are not familiar with the the Treasury market is huge, and in the Treasury market, we make a distinction where there's on-the-run securities, which are securities that are newly issued. Those are very liquid. And there's off-the-run, which are treasuries that were issued in the past. And the more off-the-run you become, the less liquid you are as a security. So their idea is to issue a lot of on-the-run securities, which are very liquid, and use the proceeds to buy off-the-runs, which are less liquid, thus improving the liquidity profile of the market. In my view, a lot of the market impact will really come down to whether or not they issue shorter dated treasury bills, which have a very strong investor demand right now, or coupons, which are longer dated treasuries, where there's less demand. If they were to issue shorter dated treasuries to buy back longer dated treasuries, that would effectively shorten the maturity profile of the treasury debt. I think that'd be more helpful for risk assets.
So is this a way of really supporting the bond market? And in another way, could this really be considered being a form of yield curve control?
It can be, depending on how it's executed. If they do actually, let's say, issue shorter dated bonds to buy back longer dated bonds, then you can, I think of it as kind of a soft form of yield control, because you're actually going out and you're placing downward pressure on longer dated yields. So I think I can think of it that way. And to be honest, I think yield curve control is inevitable, whether it be from the Treasury or from the Fed. The reason being that the amount of debt issuance that we have this year and going for the next 10 years is basically unbelievable. If you think back, just for some historical context, 20 years ago, the Treasury sometimes would run a surplus, sometimes a balanced budget. Pre-COVID, the Treasury was issuing about $500 billion in debt a year, but now they're issuing, let's say, $1 to $1.5 trillion a year, basically forever. And that is something that no government has ever done before, and it's difficult for me to see how that can be easily digested by the markets. You're going to have some significant disruptions, and the solution to that disruption is obviously some kind of yield curve control.
So, when we hear, as we did again recently, for example, Janet Yellen coming out and speaking about the debt ceiling, is that the Treasury and Congress that ultimately have control of that? And if we can keep raising it arbitrarily, what was the point of having one in the first place?
Yeah, I think the debt ceiling was actually a good idea. And back then, my sense was that there were some people in Congress who were worried about just runaway spending,
Mhm.
and they wanted to kind of put some brakes on it by creating this debt ceiling where whenever Congress hit that ceiling, they'd have to try to make some concessions, try to cut spending to stay under it before it was lifted again. Um, but all those people who thought that way, uh, they seem to have washed out of Congress. Now, I think their intuition is right that it's obviously unsustainable for a government to keep spending and spending without any thought of repaying anything. But the fact was that the government operated like that for many years to no consequence. There was no side effect to that, and I guess those fiscal hawks, so to speak, were discredited and they washed out of Congress. Um, but it seems like Congress kept pushing the envelope until we actually got to a place where we have tremendous inflation, which is where we are now. So that debt ceiling would have been a good idea, probably wouldn't have prevented us from ending up where we are today. But to me, there's just no political willpower to stop spending. So that ceiling is just going to be lifted. I don't think it's going to serve its purpose. It was worth a try, though.
As you're talking about let's say, the amount of debt that we continue to rack up, how dramatically has that grown over, let's say, the last 20 years? You've given me some examples before about the really dramatic growth, even over the past 2 years. So, how have those deficits really exploded?
So 20 years ago, the U.S. Treasury marketable debt was about 5 trillion. Now it's I think about 24 trillion. So it's exploded hugely, and like I mentioned, it seemed like the U.S. government can just just continue to deficit spend with no consequence. And if that's true, and you have this whole cottage industry of economists under the MMT movement who would say that, yeah, there's no consequence. And if money grows on trees and there's no consequence, then obviously the moral and just thing is to just keep spending and give money to everyone,
Mhm.
which is basically what we've been doing for the past 2 years. Except that it seems like we have finally reached a point where the amount of, I guess, demand exceeds the amount of supply in the economy, and so we have tremendous inflation. But it seems like the spending trajectory is already baked into the cake. One of the ways you can see that is, for example, a lot of our expenditures are entitlements, which no one has any political will to cut, and those are often inflation adjusted. So, if you're in Social Security, for example, it's adjusted with CPI, so it kind of goes higher and higher. Um, for me, it seems like we're kind of in this trap, and there's no way out.
Well, in that vein, is there a limit to the amount of debt that the US government can service as well? Every 100 basis points the Fed raises is somewhere on the order of $300 billion to service the interest on the debt alone. So, where might that limit exist?
Yeah, there's no limit. I think it's important to realize that if you have a money printer, these rules don't apply to you. So for us individually, if I borrow too much money, it's possible that I won't be able to afford it. Then I've been a big problem.
Mhm.
But if I'm the government, let's say I have my interest rates not just 300 billion, let's say it's $10 trillion a year. What do? Well, I have a money printer. I just print it and pay it. So it's never going to be a problem for me. That being said, there are costs to this. And the cost, obviously, is that the currency depreciates. And depreciation for a currency means one of two things, oftentimes both. And one is inflation. Your dollars don't buy as much stuff as they used to. So there's tremendous inflation, which we have now. And the other aspect is that your currency is worth less compared to other currencies. So that's on the FX side. So your currency would depreciate against other currencies, and that's kind of what you see in a country like Japan, where because the Bank of Japan is setting interest rates so much lower than everyone else in the world, the yen is depreciating rapidly over the past few months.
So, how is deficit spending the same as money printing?
So the way that I look at deficit spending is that when you deficit spend, you're basically borrowing the difference. So your expenditures are greater than your tax receipts. And how do you make up the difference? You go and you issue more debt, more treasuries. In a fiat system, especially when you're dealing with, let's say, uh, a core country like the United States, uh, your debt is basically money. So if you think about it, let's say I have $100 bill. It's a piece of paper issued by the government. It's very liquid, and I could use it to buy stuff. That's, to my view, not different from $100 in treasury bonds. It's also issued from the government. It's also very liquid. I can easily convert it to go and buy stuff, and it pays interest. So I I think of deficit spending as just um, printing treasuries to buy stuff. And another way you can think about it is, let's say that you go and your government. Let's say that you are a worker, and every 2 weeks you get a paycheck. Now, instead of having money wired to your bank account, let's say you have treasury securities that appear in your brokerage account. Is that really that different? You could easily liquidate those treasuries for cash. So, in a sense, I think of definite spending as basically just printing treasuries to pay stuff, which is the same as printing money. And that is, in my view, the core driver of inflation over the past 2 years, and will continue to underpin inflation for the coming decade.
Interesting. So, I want to get to all the causes and, let's say, the balance of inflation yet. But much of the world right now is suffering with the recent strength of the dollar that has been a result of the Fed raising rates over the past year. So why does this have the effect of hurting the rest of the world so dramatically as we raise interest rates?
It has to do with the privileged role the dollar holds in the global financial system. So the dollar is the currency of international trade. Most of international trade is invoiced in dollars. Um, so, for example, if you're a Japanese company buying from an Indian company, oftentimes you're going to be paying in dollars. About a little bit more than 50% of all trade is invoiced in dollars. So, what that means is that uh, things are priced in dollars for especially things like commodities. So, if you're if the dollar strengthens and you're an American and you go out and buy something through international trade, it doesn't really affect you at all because it's still priced in dollars and you're paying in dollars. But for a lot of other stuff, let's say oil or let's say wheat or other commodities, that's still priced in dollars. And if you're a foreigner, that's going to impact you significantly because in local currency terms, the price of all those commodities become higher. Let's say, for example, you're a Japanese company and you're importing oil. Um, the Japanese currency has significantly depreciated against the dollar over the past year, which is to say the dollar has strengthened a lot. So for a Japanese company, the cost of oil in terms of yen is a lot higher than it was a year ago, simply due to currency impacts. And so that kind of uh, if the price of something goes higher, you're going to consume less of it. And that also means that your economy is probably not going to be doing as well because your inputs costs are higher and people are not able to afford as much. In a sense, you can think of it as the U.S. trying to tame inflation by forcing foreigners to tighten their belts because let's say because for the US, it doesn't really matter. We're still paying in dollars, but for everyone else, dollars are more expensive. Now, this has some significant impacts on poorer countries. Many emerging markets are having trouble feeding themselves because the price of wheat and other grains have exploded in local currency terms. But again, the US doesn't feel that because our income is in dollars and we pay in dollars. It's really the foreigners that feel that. So it's part of I guess, the exorbitant privilege that the U.S. has.
Mhm. So, we've touched on, let's say, the UK gilt market as well as the Japanese example. So, does it matter to the Fed right now to take into consideration the financial stability of the rest of the world?
So First and foremost, the Fed is an American institution. They care about America. So their job is to take care of what happens in the US. Now, that being said, sometimes things that happen abroad can spill over to what's happening in the US, have a negative impacts. Now, an easy example for this has to do with, let's say, dollar interest rates. Now, the Fed tries to conduct monetary policy by adjusting interest rates. However, dollars are used and borrowed throughout the world. Let's say there's a financial accident abroad. Some company is in dire need of dollars. They go up and they bid up the price of dollars. Dollar interest rates go very high, much higher than the Fed would like it to be. This is possible because, well, financial markets are global. If you have, let's say, a company in France who really needs dollars, they can all show up in America and borrow dollars at very high rates. That would push up the interest rates of dollars. Push up the interest rate of dollars. For the Fed, it's impossible to control dollar interest rates domestically without also controlling dollar interest rates abroad, because the dollar market is globally connected. So what the Fed tries to do is that they try to act as lender of last resort, not just for the US financial system, but also the global dollar system. So what you have happening is the Fed opening up FX swap lines for many friendly central banks, such that in case there is an accident abroad, the Fed will act as lender of last resort and try to tide over that accident so that it doesn't spill in to hurt their own stance of monetary policy. More concretely, what would happen? Let's say there is a French bank who has a dire need of dollars. What they would do is the French bank would go and borrow from the ECB, who would then borrow from the FX swap lines at the Fed. So in that sense, the Fed does care about what's happening abroad, because now what happens abroad spills over to the US, and so they have these facilities to try to maintain a little bit of stability in the dollar world. That being said, what the Fed has often said in the past is that foreign central banks also have tools to address their own problems. Let's say the FX exchange rate for dollars and a foreign currency is too strong. Well, foreign central banks can always hike rates, or they could intervene in their FX markets. It's not all about the Fed. They have tools that they can use to help themselves as well.
So, as we've seen this new regime of 75 basis point hikes really over the past year here, what types of events do you think could cause the Fed to pivot from their current path?
So a lot of people in the markets mention pivot, and that means different things to different people. Some people think of pivoting as simply moving down from 75 to 50. Mm-hmm. Some people think of pivoting as actually going and cut rates. So it really depends on who you ask. Now, in thinking about the Fed, the first principle is to know that the Fed doesn't like to surprise markets. That doesn't help anyone. So they've already very clearly telegraphed that they're going to be stepping down from 75 to 50 basis points in December next month. So I don't think of that as a pivot. I think of that as them basically slowing down the rate of increases, with keeping in mind that perhaps the final destination, what they would think of as a terminal rate, which is how high the Fed will ultimately go, could be higher than what the market is pricing in right now. To me, a pivot would be when the Fed actually starts to cut rates. Mm-hmm. And I think that they're very far off from that at the moment. Now, the reason being is that basically everyone at the Fed is very aware of what happened in the 1980s. In the 1980s, so inflation was very high, and the Fed hiked rates to a high level. And then the moment inflation came down, the Fed back then, under Volcker, began cutting rates. And then the inflation came right back up, and so they had to start hiking rates again. They realized back then, so the lesson that they took from what happened in the 80s is that you got to keep interest rates high until the job is done, which is what Powell has been telling you. Mm-hmm. So from my perspective, their bar for cutting rates is very high. They're going to try to keep rates, let's say 4.5% to 5%, maybe a little bit more, for as long as they can, certainly throughout next year. That's the plan. The only wrinkle that I think that could, derail this plan would be the political pressure that the Fed might be under. So what we're seeing from this recent election is that It still seems to be very much a government that's controlled by the Democratic Party. And my sense from congressional hearings that the Democratic Party tends to be concerned a lot more about unemployment than inflation. And so, to the extent that there's a trade-off between the two, and usually there is, when you raise rates, you try to get inflation down by creating unemployment. And if you have the elected government, thinking that that's an unacceptable trade-off, then you're not going to have enough political will to carry through your plan, and maybe you might be forced by them to relent a little bit. So that's still something that we have to be watching for the coming months.
So, in your opinion, they're far more concerned about the unemployment number than, let's say, the equity markets plunging another, let's say, 20% in short order.
The Congress or the Fed?
The Fed.
I think the Fed, they want the equity markets to go down. That's how monetary policy works.
Mhm.
Powell was very clear. There are three channels from which he perceives monetary policy to work. One is that it tightens financial conditions, so interest rate sensitive sectors like housing slow down. Two is it strengthens the dollar, and three is there's a negative wealth effect.
Mhm.
It's part of going back to the framework where when people have less wealth, they are spending less, they're not able to afford higher prices, and so inflation comes down. So when the Powell sees the stock market soaring the past few weeks, he doesn't like that. That's not what he wants. And if it were up to him, my impression is that would mean that he would hike more aggressively until he gets the effect that he needs.
Mhm. Yeah, and really a lot of that hiking is about kind of telegraphing and really just putting fear into the markets, is it not?
Yeah, it's talking the market down. So
Mhm.
uh, one way to think about this is that since GFC, the wealth effect, the equity market, so to speak, has been a tool of monetary policy. If you think back to the days of Bernanke, he inherited an economy that was weak, growth was low, and inflation was low, and he wanted to help. So the idea he came up with is, what if we made everyone feel wealthier? What if I made the stock market go higher? That meant that people had more money, maybe they would spend more, and maybe that would boost growth, and maybe that would boost inflation. And so the wealth effect basically became more of a part of the Fed's toolkit. And now they're using that same toolkit, but in reverse. We have too much. We have too much money in the system. There's too much demand, so to speak. How do we get it lower? Well, we'll make everyone a little bit poor. If your 401k, if your stock market portfolio goes down 10, 20%, maybe you won't be bidding up houses as much. Maybe it will be more muted.
So, Joseph, considering some of the supply side reasons for inflation that we're currently experiencing, let's say shortages being one, does the Fed have the ability to really control this type of inflation effectively?
So, prices are always both supply and demand. When you have demand in excess of supply, then you have higher prices. Now, the way that I look at this is that inflation is always a political economy choice. It's very, very easy for a government to create inflation. Just wire everyone $1 million. They'll go out and spend it. You have uncontrollable inflation.
Mhm.
But it's also very, very easy for a government to create deflation. Let's say you double tax rates. Let's say you raise interest rates to 80%. Then it doesn't really matter what the supply response would be. You're going to get much lower prices. So the Fed can definitely tame inflation, no matter if it's supply side driven or demand side driven. It's just that whether or not you're willing to bear the side effects. If you were to double tax rates, if you were to raise rates to 50%, you would, without doubt, have deflation. There would be no inflation problem, but you could also have a large unemployment problem. So it's about the trade-offs. So I think they always have the tools. The question is just whether or not they're willing to deploy them.
Mhm. So, considering the Fed has really had a targeted 2% inflation for much of the last decade, some of that time it wasn't able to achieve that target despite many rounds of QE and stimulus. So, how do you see the balance of inflationary versus deflationary forces stacking up right now and going forward for the next decade?
To me, I think it's unquestionable that we'll have significant inflation in the next decade. And that has to do with two very structural reasons. One is that we are heading into a world where we have a shortage of labor. And this is something that we've never had over the past, let's say, hundred or even thousands of years. Over the past, let's say, I don't know how long, we've always had a growing population. We've had continually increases in the working age population. But something happened a few decades ago. People started to have smaller families. Now, if you have smaller families, and in the future, fast forward to today, you're going to have a prime age working force that just doesn't increase as much. And indeed, in the US, it's going to be pretty stagnant for the next few years. And in other countries, let's say China and the Eurozone, it's going to be declining sharply. So when you think about, economic growth, you get growth by basically having more inputs into the machine or being able to be more efficient with your inputs. Produce more outputs with the same number of inputs. This is called productivity in economics speak. If you have one of the major inputs to any growth is labor, and if you have a labor supply that's basically not growing, it's going to be very difficult for you to have more real growth. What that means is that you're not going to be able to produce more real goods and services anymore because simply you don't have as many inputs. Now, at the same time, the demand for real goods and services is going to be steady or increasing going forward. It's going to be steady or increasing because the government has promised a lot of entitlements into the system. For example, let's say that you retire today, you're not working anymore. However, you can still continue to consume based upon your savings and based upon government transfer payments, which the government finances by just basically printing treasuries. So you're going to have this huge mismatch where the supply of goods and services, real goods and services, is basically going to stagnate or grow at a very slow level, and the demand for them isn't changing very much. So to me, that's just a very clear indication that you're going to have higher inflation for the next decade to come. This is actually not my own theory. It's a theory about someone called Charles Goddard, who was a very smart professor and former central banker in the UK. And I think he's completely right, and we already see some of that today. One of the interesting aspects of the pandemic is that after post-pandemic, you see help wanted signs everywhere, not just in the US, but in the developed world. And you see wages going very much higher. And if you look at the underlying data, what you'll notice is that so during the pandemic, everyone stayed at home, and then after the pandemic, everyone went back to work. Everyone went back to work except the baby boomers. Their labor force participation plummeted and did not go back. So what you're seeing really is just that decrease in the supply of labor happening a little bit earlier than planned. And if you have a decreased supply of labor, prices of supply of goods and services can't grow as much. Prices of those goods and services go higher because the boomers, they still have enough money to spend, both from Social Security and from all the wealth they've accumulated over the past few decades.
How do you see energy playing a role here as well? Do you really see that big portion of every input to society having a massive role to play in the higher price level that we're going to be paying through this decade, as you say?
So energy, it seems like we have a shortage in energy. There are many people who focus on the sector much smarter than I am, and they've seemed to be on the same page in saying that we haven't invested enough in things like energy, not just energy, but basic materials, say mining, copper, let's say aluminum, things like that. And again, that goes to a supply shortage story in addition to labor, where you don't have enough inputs going into the growth of inputs is not going to be high in the next few years, and that again suggests that you're not going to have as much stuff. And so if the demand for stuff stays the same, then prices are going to go higher. I think that's a very compelling story to me, and I believe it. But just one thing that I would note is that, well, these things can actually be solved within a few years. For example, what we're hearing today in the news is you have tremendous amounts of oil discovered in Guyana, and perhaps the Eurozone decides to stop committing suicide and start fracking in, let's say, in the UK and other places. So you could have that fixed, and let's say not immediately, but in a few years. What you really can't fix is the labor shortage, because it takes 25 years to create another worker, and it doesn't seem like we're heading towards that direction.
Mm-hmm. So does credit growth continuing to be strong end up being healthy for the consumer and for just businesses in general?
For the consumer, it really depends. For businesses, yeah, I mean, if you have people taking out loans to go buy stuff, that means people have demand for your product. That means you can continue to make money. For the consumers continuing to borrow, that really depends on two things. Are you able to service that debt, and what are you using the money for? Perhaps you're using that money to invest in a new business or your education. That's a good investment that's likely worthwhile. Um, or maybe your wages are growing at a 6-7% rate, a rate that's higher than your debt. Then you can service that. That's not a problem. It's really context dependent. But just looking at the data overall, well, I mean, inflation is high. Interest rates are not as high. So you have, in some segments, real interest rates that are very low or negative. So it seems that would be easily serviceable.
Mm-hmm. So interestingly, in the Fed's latest financial stability report, they pointed out that they think that stocks are around the historical median, yet commercial and residential real estate is very overvalued. So would they have the ability or the need to target these sectors individually?
I don't think they have the. So I think residential real estate is something that real estate in general is something that the is slower than the equity markets, right? It takes it Now, if you think back to what happened during the GFC, so the stock market imploded and bottomed in 2009, but the real estate market continued to slowly grind lower, and I don't think it bottomed until, let's say, maybe 2011, 2012. So the real estate market is always slower than the stock market. That's one thing. And the second part is that the real estate market is most sensitive to longer dated interest rates, let's say the 10-year. Because a lot of it is financed with mortgages, which are priced off of, let's say, the 10-year, and the 10-year rate has gone up a lot, and it seems like I don't think they're going to need to target do any targeted intervention, because it seems like it's slowly going to filter in, and we'll see that real estate prices correct. If they wanted to do more targeted intervention, they could do this through the regulatory powers that they have. For example, they could go to a bank and they could set it so that the regulatory costs of a bank giving a mortgage are higher. That would force the banks to charge higher rates for mortgages. So they definitely have these tools in their toolkit. I don't know if they need to deploy them, though. It seems like over time we'll just see the real estate market correct to I guess a bit more reasonable cap rates.
So, Joseph, considering your very, very wide breadth of knowledge and expertise here, where do you think the biggest risks right now in the markets lie?
So I think there's actually tremendous risk in the treasury market. There's a couple ways to think about this. Now, people think of the treasury market as the deepest and most liquid market in the world, but over the past few years, we've seen it it blew up. I think there's a flash crash. I think it was 2014, and in 2019, you had this tremendous spike in the treasury repo market, where interest rates spiked from, let's say, 2% to as high as 10% intraday. And if you just look across the pond, you had the UK gilt market meltdown as well. I think that is a very, very likely scenario to happen in the treasury market as well, depending on whether or not the authorities act in time. This is very dangerous because the treasury market is basically a foundational asset. If you have treasury yields spike higher, then everything that's priced off of them is going to spike higher as well, and that's going to force a lot of selling throughout the markets. For example, let's say that you are a traditional asset manager. Let's say you have a portion of your portfolio in treasuries and a portion in stocks. Mm-hmm. If you're having big losses on your treasury portfolio, you're going to have to go and sell some of your stock portfolio to rebalance back. And so losses in the treasury market spill over to basically all markets. So I think that's probably, a non-trivial tail risk that we'll be looking at in the coming months. However, if that does happen, I think it'd be very short-lived. You'd see the Fed or the Treasury come in, intervene, and settle things quickly. But that being said, they could be comfortable with a much higher level of Treasury rates than the market realizes. Now, earlier in the year, I was telling everyone that Treasury yields would go above 4%. No one believed me. Now, we're a little bit below 4%, but I think we'll go back up. What if we settle at 5% or more? I think that doesn't sound good for a lot of risk assets. A lot of people, I think, would rather get a 5% Treasury than, let's say, invest in a tech stock.
Do you do much research or pay much attention to the Treasury auctions and who is buying them, and let's say looking at those trends over time?
Yeah, so the Treasury auction data, it comes in two types. It'll tell you basically who, if it was bought by, let's say, there's two layers to this. One is the actual investor allocation. They'll tell you if it was, let's say, by asset manager or by a dealer or something like that, and that's at a delayed time frame. And the other aspect is it'll tell you during auction if it was bought by directs, indirects, dealers, and so forth. When I look at that data, it doesn't seem to tell me that much, but it's hard to know because you could buy it and then you could actually sell it, and then it's a different type of investor.
Okay. So the reason I ask that is because I've heard that there is a trend that less and less foreign countries are buying bonds and treasuries. So is that a theme that you see that is accurate, and or is it worrying to you if it is present?
So usually what people look at to judge whether or not foreigners are buying is to see the percent of indirects that are taking down on auction. An indirect is someone that's bidding through a primary dealer, and that's usually a proxy for foreigners. It's definitely so. There's two ways to look at this. So when you look at foreign investors, people look at foreign investors in two types. There's a private sector foreign investors, let's say a Japanese life insurer, or there's a public sector life investor, let's say a central bank. Now, these two classes of investors operate differently. Now, if you are a public sector investor, let's say the central bank of, I don't know, Tajikistan, let's say that why do you hold treasuries? You hold treasuries because it's kind of like a rainy day fund that you can use in case you want to intervene in the currency markets. So when you have the dollar strengthening significantly, let's say you don't want the dollar to strengthen significantly. So what you'll do is you'll sell some dollars and buy your own currency so that your own currency doesn't depreciate as much. So mechanically, what that means is that you will take the treasuries that you hold in your giant special brokerage account, you'll sell them, you get dollars, and then you'll sell those dollars and buy your domestic currency. That's a way to insulate your home country from a strong dollar. Now, right now, what's happening because the dollar is strong? Not everyone, the foreign official sector more generally is selling treasuries, so they're not buying. So that demand is not there. And that has to do with just their monetary policy. They're trying to support their currency. Now, the private foreign sector is different. It's different because they're holding treasuries as an investment. Now, there's a couple ways that you can make money as a foreign investor in treasuries. One is that you can go and you can buy treasuries and hope that you make money, either mostly through the dollar appreciating. So in a sense, it's kind of a currency play. So perhaps you're a foreign hedge fund, you think that the Fed is raising rates, the dollar is going to strengthen. So you want to go long the dollar. What does that mean? Does that mean you have a bunch of money sitting at Citibank in dollars? It usually means that you're owning treasuries. So that's some demand there. I think the greater part of the foreign private investor demand, though, has to do with, let's say, big institutional investors that actually have to hedge the currency exposure of their treasuries. So what that means is that, so if you're a Japanese life insurer and you're going and you're buying a bunch of treasuries, so let's say the treasury yield is 3%. 3%, that's not great, but it's much better than JGBs. However, let's say that the dollar depreciates by 1%, and sometimes it can do that in a day, then you basically lose all your returns. So what you do as an institutional investor is that you FX hedge your treasury holdings. At current market rates, you're not able to make money on an FX hedge basis. It doesn't really make sense. You'd rather just buy your home country, let's say JGBs in this case.
Mm-hmm.
And so in that essence, there's not as much demand for private sector treasuries, private sector foreign investors that FX hedge their treasury investments. So yeah, I think overall it looks like foreign demand is not going to be strong for the coming months.
Interesting. Joseph, as we kind of wrap up here, is there anything else you think that's worth touching on that we haven't really gotten to?
I think what's something that we should keep in mind is that a lot of so that there are significant geopolitical risks in the world, and that has significant implications for assets, but not in the way that many of you think. What it appears to me is that there seems to be a proxy war in Europe against Russia, and it seems to me that maybe people are trying to stir up a proxy war against China as well. Now, when you have things like this happen, people abroad, they're going to try to now, war sounds not good for risk assets, but you have people abroad in Europe or in Asia who are trying to get away from that. So what they'll often do is they'll hide their money in safer jurisdictions. And in this case, it's the US. So you could have tremendous, let's say, inflows into US dollar assets, not just to treasuries, but to the stock market as well, from foreigners that could be, I think, supportive of US assets going forward. So I think that's something to keep in mind as well, depending on how political developments unfold.
Mm-hmm. How much more of an effect does interest rates continuing to climb also going to have on that, let's say, those foreign market dollar inflows into the US?
It helps. I mean, so people could come in, for example, they don't have to buy Apple, they don't have to buy treasuries. They can just come into the US and they can invest overnight at a money market fund and earn what looks to be pretty good yields globally as well. And that's one aspect. But there's also another self and reinforcing aspect in that if you're a foreigner, you can, let's say you're a Japanese investor, you come in and invest in a US money market fund, you make 3-4%. That's good. But if everyone is also doing that, then you're also going to make money on the currency appreciation as well. So it's kind of like a double play. So it's a self-reinforcing loop that could be supportive of U.S. assets. So I wouldn't just focus on what's happening in the U.S., thinking that raising interest rates is really bad for U.S. assets. The economy is not the same thing as the stock market.
Mm-hmm. Yeah, it's such a complicated picture, and I really appreciate you helping us trying to make some sense of it. You have a really active Twitter feed at FedGuy12 where you put a lot of great information up, as well as your blog. You write some longer form stuff at fedguy.com. Anywhere else you'd like to point to, Joseph?
No. Thanks for having me. If you guys are interested in learning about the monetary system and central banking, I know many people in your audience are. So you can check out my book on Amazon. It's got Central Banking 101. It's basically a introductory overview of how the monetary system works. It goes over many topics that I think would be of interest, and it's well reviewed on Amazon. We have a few hundred 5-star reviews.
Excellent. Yeah, it's always good to learn more about how all of these things work, and hopefully in a simpler way to understand it. You can kind of broaden your knowledge there. Joseph, thanks so much for your time today. Really appreciate you sharing it with us.
My pleasure, Tom. Thanks for inviting me.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.